Slowly kisses passing by the river.
Firstly, our group chooses Uzma Berhad to evaluate the company's performance of financial statement. For your information, Uzma Berhad is one of Malaysia's leading upstream oil and gas service and equipment firm. The report is made based on Annual Report 2019 and we are required to check their historical performance to estimate for future performance. There are several of objective financial ratio analysis which are to standardize financial information for comparative purpose, to evaluate the company's current operation, and lastly, to determine the efficiency and risk of operation. The main point of this report is to analyze Uzma Berhad past, present, and expectation for their future financial performance. It allows a comparison of the company's performance with the competitors in the same industry. Next, we can identify the company's strengths and weaknesses. It is necessary to identify both sides so the company can capitalize on the strength and take the initiative to improve their weaknesses. Besides, the relevant parties such as potential investors need to know whether the company has the potential to make any profit or be able to increase the profit for present performance compared to past performance. We will discuss the main type of financial ratio. The first one is liquidity ratio. It shows that a company can meet its short-term financial obligation whether the company has the resources to pay its creditor when the payments are on the due. Second, leverage ratio. It measures the level of debt or borrowing in a company. It is used to increase the potential return on investment and helps the company to operate. Third, is profitability ratio that measures how effectively the company uses its asset in making profit and indicates the company efficiency in controlling the cost and its pricing policy. Lastly, the common sense ratio that allows the company to evaluate the performance and to identify the trend based on their past financial statement. Even though financial ratios are helpful, there are also limitations to ratio analysis. The limitation need to examine before making any decision toward the company's performance. It is essential to explain the ratio correctly until getting the right decision.
Uzma Berhad is an international oil and gas service company providing an array of services to the upstream sector across the exploration, development and production phases and to the downstream sector for facilities and plant construction, operations and maintenance. It is located at Petaling Jaya, Malaysia. Uzma Berhad established in year 2000. The business started by providing professional consultancy services to its clients. Since then, the company has gone through rapid growth driven by its vision to be a leading oil and gas service and equipment (OGSE) companies in Southeast Asia. The group's growth was fueled by adding new innovative service offerings beyond consultancy services and a market expansion beyond Malaysia. Uzma Berhad's mission is to be an integrated regional OGSE company with a diverse portfolio that adds value throughout their niche and innovative solutions. They also provide innovative and cost-effective solutions to the exploration, development and production value chain of the oil and gas industry. Without further ado, we will now discuss about the ratio analysis on Uzma Berhad's annual report for the year 2019. The first ratio that we will discuss is liquidity ratio. Liquidity ratio is a ratio that measures a firm's liability to meet its short-term financial obligations, whether the company have enough resources to pay its creditor when the payment is due. It consists of current ratio and acid test ratio or quick ratio. Uzma Berhad current ratio is 1.81 times, which is higher than the industry average. This is reflected by the higher current ratio as compared to the industry average. The ratio indicates that the company's performance is good as it could meet its short-term obligation. It means that the company have no problem and can pay its current liabilities on time without liquidating its current assets. For every 1 ringgit of current liability, the company have 1 ringgit and 81 cent of current assets to meet its short-term obligation. It means that Uzma Berhad does not have problem in paying their current liability on time. The possible reason on how the company's current ratio is higher than the industry average may be due to the effective management of current liabilities, as the company may reduce them by paying the existing creditors or by using long-term sources for future financing. Ways that can be implemented by the company to improve its liquidity position is by improving the company's cash collection system. For example, by giving cash discount to encourage debtors to pay their debts sooner than the actual date for the companies to receive their cash early. Other than that, the company should also monitor their account receivable effectively to ensure that the company are billing their clients properly and that they are receiving prompt payments. Lastly, Uzma Berhad should also negotiate their payments term with their vendors whenever possible to keep their money longer to improve the company's liquidity performance. Next is acid test ratio. The company's acid test ratio is 1.7 times, which is higher than the industry average. This is reflected by the higher acid test ratio of the company as compared to the industry average. The ratio indicates that the company performance is good as it could pay its short-term liabilities and its immediate obligations, as the company have enough resources to pay its creditor when the payment is due. For every 1 ringgit of current liability, the company has 1 ringgit and 70 cent of liquid asset to pay its current liability. The possible reasons on how the company's current ratio is higher than the industry average is because of the company did not hold too much inventory and have a good debt collection. This made the company have enough liquid asset to pay its current liability when the payment is due. To maintain the company's liquidity performance on acid test ratio is by promoting cash sales. For example, by giving cash discounts to customers to encourage them to pay their bills within a specific time. This will somehow reduce the impairment loss of trade receivable and lead to improvement in acid test ratio. Other than that, the company can also improve their liquidity by adopting an effective inventory control system such as economic order quantity (EOQ) or material requirement planning (MRQ) method to make sure that the company can manage their stock effectively.
Next, we move to leverage ratio. To summarize it, the function of leverage ratio is to measure level of debt or borrowings in a firm. Leverage ratio consists 3 elements, which is debt ratio, debt to equity ratio, and time interest earned. First, let me show you Uzma Berhad's debt ratio. As we can see, Uzma Berhad's debt ratio is 55.66%, which is higher than the industry ratio that is 47%. As a result, it indicates that the company's performance is bad since the company has a higher borrowing compared to other companies in the industry. Besides, from the calculation, we can see that 55.66% of the company's asset is financed by liability and 44.34% is financed by equity financing. One of the possible causes why Uzma Berhad's debt ratio is not good are they have a higher borrowing, which leads to low ability to settle debt obligation, as we can see in the annual report. Thus, in order to get back in shape and get good performance for debt ratio, the company, which is Uzma Berhad, should reduce operation costs, avoid any new borrowings from the third party, and collect payment from customer immediately. Second, we will go to debt to equity ratio. For our company, which is Uzma Berhad, debt to equity ratio was 125.55%, which is higher than the industry ratio that is 41.9%. Therefore, the company's performance is bad since the company used more borrowings and less equity as the source of financing. According to the calculation that has been made, the creditors provide 1.2555 for each dollar provided by stockholders to finance the assets. The possible causes of this unsatisfied debt-to-equity performance is the company may be borrowing more than is necessary and does not issue any preference share due to the lack of equity. This can be proved by the annual report of Uzma Berhad. Hence, there are several recommendations that should be taken by the company as soon as possible to improve the debt-to-equity ratio, which is Uzma Berhad should have an optimum mixture of sources of financing and avoid any additional debt to the company. Last but not least, our last element in leverage ratio, which is time interest earned. As stated above, we can see that Uzma Berhad's time interest earned was 1.72 times, which is higher than the industry ratio, that is 1.4 times. It indicates that the company's performance is good as the company's ability to fulfill interest obligation is higher. Based on the calculation that has been made above, the company's time interest earned of 1.72 times mean that the interest expenses of the company are 1.72 times covered by its net operating income, which is income before interest and tax. The possible causes why the time interest earned of Uzma Berhad is good is the company's success in fulfilling the obligation. Of the higher the ratio, the higher the company's ability to fulfill the interest obligation. Thus, to be concluded, the company must maintain its performance by reduce their interest expenses, increasing their sales and increasing their operating costs, same as they have been practicing now.
Next, let's move to profitability ratios. Profitability ratios is the ratio that measures how effectively the company uses its asset to generate profits. There are several types of profitability ratios. Firstly, gross profit margin. Gross profit margin is the margin that measures the percentage of sales after deducting cost of goods sold. As we can see, gross profit margin for Uzma Berhad is 33.24%, higher than the industry average at 19.03%. From this, we can indicate that the company is good in maintaining efficiency to control its cost of goods sold and have a good pricing policy. Furthermore, the gross profit margin of 33.34% indicates that for every RM1 of the net sales, the company managed to get RM0.3324 as gross profit after deducting cost of goods sold. In addition, the possible cause for higher ratios are because of sufficient sales volume and lower cost of goods sold. Thus, to maintain the good performance, Uzma Berhad may review its pricing policy, change the supplier, and eliminate unsatisfied labor to decrease the amount of cost of goods sold. Secondly, operating profit margin. Operating profit margin is the margin that demonstrates the revenue after deducting all the variables or operating costs have been paid.
From the calculation had made, the operating profit margin for Uzma Berhad is 11.31%, higher than the industry average at negative 4.52%. From this, we can indicate that company's performance is good and has higher profitability. Furthermore, the operating profit margin of 11.31% indicates that for every RM1 of the net sales, the company managed to get RM0.1131 as operating profit after considering all the operating expenses. In addition, the possible cause for high ratios are because of lower cost of goods sold and lower operating expenses. Thus, to maintain the good performance, Uzma Berhad need to reduce operating expenses and reduce the cost of goods sold.
Net profit margin is the ratio of net profit for a company or business segment. It is calculated by dividing the net income available to common stockholder by total sales. The company's net profit margin is 7.43%, while the industry average was recorded at negative 9.46%, which means the company's net profit is higher by 16.89%. It shows good performance by the company in managing their profit, and the costs and expenses are well utilized. The company is making 0.0743 for their net profit from RM1 of their net sales. The possible causes that indicate the net profit higher than the industry average is possibly due to operating expenses spent by the company is lower than the industry average. Other than that, maybe the company spend less on their debt financing, and probably low tax payment levied on the company on that year. So the company are recommend to explore more on their investing activity and increase their current service charge to improve their net profit margin. Return on asset is also known as return on investment. It indicates the management ability to make profit from the firm investment in their asset. It is calculated by dividing the net income available to common stockholder by total asset. The company's return on asset is 2.72%, while the industry average were recorded at 0.62%, which means the company's return on asset is slightly higher by 2.1%. It means the company are doing good at managing their asset. Company is making 0.0272% for their return on asset from RM1 of their net sales. Higher return on asset is probably due to efficiency in their asset, and also company assets are less intensive compared to the industry average. To improve their return on asset, the company are recommend to monitoring their monthly asset expenses, such as they can decrease the cost of the asset by just renting or leasing the equipment needed instead of their buying the asset. Return on equity measure the profit earned by the common stockholder from the investment in the company. The higher the return on equity, the better return for the shareholder. It is calculated by dividing the net income available to common stockholder by common equity. The company's return on equity is 6.13%, while the industry average were recorded at negative 0.24%, which means the company's return on equity is higher by 6.37%. The company showed good performance in managing their common equity. The company is making 0.0613 cent for their return on equity from RM1 of their net sales. Higher return on equity is probably due to efficiency in common equity management. Besides that, Uzma Berhad is maybe one of the high growth company among the industry, which means normally high growth company they have high return on equity. Other than that, company maybe buy back their share in order to increase their return on equity. The company are recommend to increase their net profit by increase their pricing on product and services, and also reduce their overhead costs in order to improve their return on equity. As you can see on the table above, there are increase and decrease for every item in the statement. Let me explain why the changes happen throughout the year. I will start with the non-current asset. The first item is property, plant and equipment. There is an increment of 6.82% in 2018 to 2019. The changes happen because there is a new purchase for operating equipment, furniture, fitting and renovation, motor vehicle and office equipment. Moreover, the analysts and potential investors are always evaluating a company's asset to see how the company manage the capital to invest in the acquisition of new assets, which will further in improving the profitability of the company. Therefore, the company must purchase additional properties to maximize and boost the production of output. Second, the intangible asset arise from 12.08% to 26.29% in 2018 to 2019 respectively. This increment can be justified as a new acquisition in goodwill and other intangible assets. Next, there are no changes in the investment of subsidiary at all. Next, the investment of associate slightly increased by 0.11% from 2018 to 2019 because there is an increase of 1.48 million in the share of profit from the associate. For investment in joint venture, there is no amount in 2019. Long story short, on 31 January 2019, the company's subsidiary Tenggara Energy Sdn Bhd had acquired additional ordinary share in Setegak Venture Petroleum Sdn Bhd that called as SVP. It represents additional 15% equity interest in SVP for a cash contribution of Rm 36 million. Consequently, SVP became a 64% owned indirect subsidiary of the company. We will look to the deferred tax asset that dropped from 0.48% to 0.3% in 2018 to 2019 respectively. The reduction can be identified as acquisition of subsidiary. The difference in deferred tax may be due deductible temporary differences, unused tax losses or unabsorbed capital allowance based on the projected future profit on the subsidiary. Besides that, deferred tax asset and deferred tax liability are offset if there is legally enforceable right to offset current tax asset against current tax liability. As a result, each year the deferred tax asset will be different because it depends on the offset of the current tax asset. Besides, there was a significant decrease in trade and other receivables of 11.28% to 0.87% from 2018 to 2019. This is because the amount owed from third parties was settled in early 2018. Last, for non-current asset is other investment. It has been dropped from 2.32% to 0.57% due to investment unquoted equity security of the group. It's stated at cost because the fair value cannot be measured reliably. I will carry on to the non-current liabilities. First item is loan and borrowing. From the table above, the loan and borrowing show that it has been dropped from 96.55% to 95.57% in 2018 to 2019. It is because the company settled all the debt within 5 years. Next, deferred tax liability. There is an increment of 0.31% in 2018 to 2019 because there are differences between the carrying amount of property, plant and equipment and their tax base, and deferred tax of liability arise from acquisition of a subsidiary. For trade and other payable, there is no amount in 2018 because all the creditors had paid their debt in that year. The last item for non-current liability is post-employment benefit liabilities. It is decreased by 0.19% from 2018 to 2019. The recognition in profit or loss increased up to 19,000 in 2019. It stated that the actuarial gain recognized in other comprehensive income up 23,000 in 2019.
From the report that had been done, we can conclude that Uzma Berhad performance is satisfying, but the company should focus more on leverage ratios to decrease the company's ratios than industry average. Hence, Uzma Berhad may reduce its additional borrowing to finance the company's asset using the company's shareholders' equity. Thus, it will reduce the potential losses that may occur in the event of liquidation.